Are you interested in buying Nigerian stocks for long term? Maybe you're looking for a guide on how to build a defensive, recession-proof portfolio that can help grow your wealth in the long run. Maybe you want to hold a stock for at least 5 years, 10 years, 15 years, or more. In this video, I want to show you how to properly do a research, how to find a stock you should be holding for long term. It's not every stock that you buy that is good for long-term investments. Some are only good for trading, while some are good for investments. And from what my personal research has revealed, most Nigerian stocks are not good for investments. Only a few of them are good for long term. And if you decide to hold a stock for long term without doing proper research, you might be exposing or you might be at risk of loss because anything can happen. Uncertainties are real in the Nigerian market. Policies changes, uncertainties, political instabilities, and a lot. So your ability to find companies that will stand, companies that will survive, companies that will be resilient, companies that would be able to weather off all these events and still be able to generate profit in the long run is what actually makes you a solid or a profitable long-term investor. So here I want to show you how to do a proper research for long-term investing in the Nigerian market. So let's move to the next slide. So here's my disclaimer. The ideas shared in this video are based on my risk profile and also kindly be advised that whatever stock I mention, you need to do your research. You need to ensure that they align with your risk profile too, and understand the fact that the stock market has its own risk. So especially uncertainties. So it's very important that whatever stock I mention, please do your own due diligence before you invest in them. Now, long-term investing is a buy and hold strategy where you acquire shares of a company for regular cash dividends, reinvesting, and then continue to hold for at least 5 years and above. It is not an easy analysis. You don't just look at a stock and say, oh, I like this stock, let me hold for long term. It's not a guarantee. The risk of loss is very, very high because anything can happen. So it is actually in long-term investments that your proper detailed due diligence is required because holding a stock for 3 years into 4 years into 5 years into 6 years into 10 years is it's not easy. You need to do a proper research. It's not something you do out of thin air. It's not something you do out of emotion. There's no need for gambling. You must learn the rope of long-term investing. If you're not ready to hold a stock for long term, if you're not ready to weather volatilities, uncertainties, then you might actually not be fit for long-term investing. In long-term investing, like I said, proper risk reward is very important. Uncertainties, regulatory policies, instabilities are major issues you need to assess critically before investing your money. These are key points. Look at the risk reward ratio. Is it worth the risk? If I'm going to hold this stock for long term, for at least 5 years, 10 years, is it worth the risk? I understand the risk of uncertainties, but what's the tendency that this stock will give me return that would justify that risk? These are the things you put into place. Then uncertainties, regulatory uncertainties. Government is always coming up with policies, like instability when there's change in government, because in holding a stock for at least 10 years, it's going to pass through different administrations. And you know one thing in Nigeria, political instability is a major problem, it's a major challenge. Every new government we've had, they come with their own policy, they jettison the previous one. So the company you're investing in, have you checked whether they have that internal structure or they have that competitive advantage to weather the storm? These are issues you need to take into account. You need to do a research on before you can buy that stock. Then um, some of the things I'm going to discuss right here are practical strategy to find winning stocks in Nigerian markets for long term, and then how to increase your chance of investing right. This is very important. How to increase your chance of investing right. I only own just two stocks for long-term investing, two of them. And I decided to stick to that too because they met my core and stringent criteria. Now, it doesn't mean that they are the best in the market, but then for now, they are the best as far as my research is concerned. Now, I'm still looking to increase maybe later on, because I'm still carrying out more research as I record this video, just to find more stocks that are good for long term, because I plan to add that to our monthly slide. So each time we host our monthly webinar, I want to talk about some of the stocks that you should be considering for long term based on certain metrics. So, warning, the stocks I mentioned may go through market volatilities in the short run. Long-term investment is highly risky, the same way short-term investment is also risky. So when you decide to hold a stock for long term, be ready to ride market volatility. Be ready to stomach risk. You may watch your stock dump by 20, 30% before it picks up again. The question is, can you stand? Can you withhold that dip? If you're not ready to ride the market for fluctuations, long-term investing is not for you. Long-term investing is for people who are saying, come rain, come sun, whatever happens, I am holding this stock. I am staying put on this company's stock. So even if they watch their portfolio or they open their portfolio one day and they see that the stock is down by 20, 30%, they are not worried. They are not bothered. Why? Because they have resolved to hold it. They have resolved to hold it after carrying out due diligence. So when you want to hold a stock for long term, the first thing you need to ask yourself is, what's your long term investment objective? Yes, everything must have a goal. There must be a reason why you are embarking on this journey. So before you start accumulating a stock, find out what your actual goals are in 5 to 10 years. Why are you buying that stock? What is the essence? Are you buying for dividend only? Oh, I only want to buy for regular cash flow. I'm retiring soon. So I want something that will give me cash flow, something that can give me certain amount of money every year for life. Or I am buying for both dividend and growth. Oh, I want something that will give me regular cash flow as well as increase my capital over time. That's the growth nature. So these are combination of dividend and growth in the market. Is it possible for you to buy a stock that will reward you handsomely via dividend and also record significant capital appreciation? Very, very possible. Very, very possible. Example of such stocks in the Nigerian markets is UCAP. This is not a buy recommendation, but I'm just letting you know that it's possible for you to buy a stock and then collect dividend while also recording significant capital appreciation. So this is UCAP. If you see, as at 2020, UCAP was still selling for 82 kobo into 1 naira. Now, UCAP today has stopped 20 naira. In short, the price should have hit almost 50 or 60 naira, if not the bonus and the splits. Now, from the chart here, you can see how the stock has moved from 1 naira to reach a high of 19 naira between 2020 and 2024 in 4 years. Now, how much has UCAP paid? UCAP is another strong stock in the market that pays consistent dividends. They pay dividend consistently. So imagine buying UCAP at 1 naira, you're collecting both dividend, and imagine what your portfolio would have looked like if you have if you are still holding for like 4 years, from 1 naira into 14 naira, 20 naira, sorry, that's almost 20x, at least 10x, 15x in the market. Your capital would have grown by 15. So if you multiply 15 by whatever amount you have invested, let's say you invested 1M, your capital would have moved into 15M. And remember, you are still collecting dividends. So it's possible for you to buy a stock for both dividend and growth. So we call it dividend growth stock. Or maybe you're targeting a seat in the company, maybe you want to be an MD, or you want to target, you want to be a major investor, you want to acquire the company or whatever. So for the purpose of this section, we'll be looking at the second part, which is dividend and growth. Why am I interested in dividend and growth? Because I want to beat inflation. I do not want to buy a stock that will just pay me dividend, and then if you look at my capital is probably going down. There are stocks that you buy, they pay you dividend, but they don't record significant capital appreciation. So it might actually take time for you to beat inflation. And before you even hold the stock for like 5 years or thereabout, inflation would have even surged higher. So it's good for you to look at an investment that will be able to beat inflation in the long run. So let's look at difference between dividend stocks and dividend growth stocks. Now, dividend stocks pay regular cash dividends, but do not necessarily record significant capital appreciation. You buy them, you hold them, keep them. Your essence is basically cash flow. You're not interested in capital appreciation. You don't have a plan to sell it tomorrow. Do you understand? Why dividend growth stock? You buy them, they pay you regular cash dividend, and as well record significant capital gain or capital appreciation. Now, one good thing about dividend growth stock is that you can actually use them to plan a project. So imagine buying a stock and you know in the next 5 to 10 years, this stock can appreciate significantly while also paying you dividends. So that means you can actually use this kind of stock to plan a major project because in the next 5 years, the price of that stock would have appreciated and then the company is still paying you dividends. So when you buy a stock for long-term investments, you need to answer this question. Are you buying for dividend only or are you buying for dividend and growth? I prefer dividend growth stock. I prefer dividend growth stock. It's very important. I prefer dividend growth stock because my capital is also important. Inflation is you must understand the effects and the place of inflation in your finance. You can't afford to ignore that particular threat. If you hold a stock worth 1 million naira today and the stock is paying you dividends, and that 1 million naira is still within 1.1, 1.2, or down to 1.1, no significant capital appreciation, but you're collecting dividend regularly. In 5 to 10 years, inflation would have wiped out the value of that money except you decide to reinvest your dividend and say, okay, let me reinvest my dividends to cushion for that. Fine, because dividend stocks plus dividend payouts plus reinvestment equals capital appreciation in the long run, whether the market is up or down. I have a course where I was able to demonstrate that even if the Nigerian stock market crashes today, if you decide to reinvest all your dividends for the next 5 years, you will record significant capital appreciation. So another way to enjoy capital appreciation is dividend plus reinvesting. It's a proven formula. Dividend plus reinvesting. Because when you collect your dividend and you are reinvesting that money on the stock, it's like you're picking the stock at zero cost. And when you pick up the stock at zero cost, look at the value of your portfolio, it grows naturally. So dividend plus reinvesting equals capital appreciation. Now, when you now apply this model on a dividend growth stock, it's going to be massive capital appreciation. That means when you collect dividends, you use it to buy the stock. Tomorrow, the stock price appreciates. So the first one is dividend plus reinvestment equals capital appreciation. Why? Dividend plus reinvestment plus growth equals massive capital appreciation. So dividend stocks pay you regular cash dividends as well record significant capital appreciation, capital gain, sorry, from share price appreciation. So let's look at the strategies to build a profitable long-term portfolio of Nigerian stocks from scratch. So let me show you what I do to search for stocks that are fit for long-term investing. Remember, we are interested in dividend growth stocks that will pay us dividends while also recording significant capital appreciation in the next 5 to 10 years. I'm not saying that capital appreciation must come this year, but at least if you look at it over time in the next 5 to 10 years, you're very sure that this stock will record significant capital appreciation while paying you dividend. Another example of a stock like that is Seplat. Look at Seplat. Seplat has been paying dividends and Seplat has recorded significant capital appreciation. This is exactly what we call the dividend growth stock. A combination of both dividend and growth. Imagine buying Seplat when it was still selling for between 400 to 500 in 2021, meeting a match from COVID. Now, Seplat is selling for almost 5,000 naira. Multiply sorry, check the return from 500 to that's almost 10x. And then also look at dividend paid so far between 2021 to 2024. Imagine that you have been reinvesting the dividend over time while the share price is rallying. That's massive capital appreciation on your portfolio. So there are stocks in the market that you can buy for both dividends and capital appreciation. That's how to build a solid long-term investment. That's how to build a solid long-term investment because your investment is giving you cash flow and it's also outperforming inflation in the long run. That's the kind of investment you should be holding for long term. So you don't just settle for any random stocks, regardless of how you feel, regardless of how you feel. When this strategy tells you this stock is a buy, go for it and hold it for long term. So let's look at the strategies to build a profitable long-term portfolio of Nigerian stocks from scratch. First one, fish from hottest sector. The first place to search for stocks you should be holding for long term is in sectors that have been hot and will continue to be hot for an extended period of time. For an extended period of time. That's the first place. There are sectors in Nigeria that in the last 5 years, they have been hot. In the next 5 years, they will continue to be hot. In the next 10 years, they will remain hot. In the next 15 years, they will become hotter. And the next 20 years, they are still hot. No doubt. These are the sectors you should be fishing your long-term investment from. Like I always say, a significant portion of capital appreciation on your stock will come from events in that sector, not necessarily the company. Capital appreciation will come more from the sector. So the sector that your stock is will play a larger role in determining whether investors will continue to mop up stocks or not. When long-term investors, when big money managers want to do long-term investments, there are things they consider. Sector effect is very key. That's why at the end of the year, maybe every quarter, every year, they release their annual review. Annual, some of them will call it macroeconomic outlook. Some of them will call it whatever trend, what to watch, event. Trend. Why? Because they do not joke with sector events. And sector event is driven by macroeconomic outlook. So when you want to fish for stock, go for stocks in sectors that have been hot. Example of a sector that have been hot for a long time and will continue to be hot in the next 20 years is food. We eat every day. The food sector is hot. The food industries is hot. So when you buy a stock in that sector, stocks that produces food, what we eat, and they have very good financials, you are actually at an advantage. You ride the sector. Inflation has been hot in Nigeria for a long time. And inflation will continue to be there because the government is here to come up with policies that will tame inflation. Despite CBN interest rates, the last 5 years, what effect has it had on inflation? None. Inflation is still getting hotter and hotter and hotter. So when you focus on companies that are benefiting from inflation in the long run, as inflation becomes hotter, their share price is also becoming hotter. Why? Because they have the capability, they have the ability to adjust their price in line with inflation without losing customers and also make more money. So focus on sectors that have been hot. There are sectors that have been hot in Nigeria. Now, when you want to pick sectors that have been hot in Nigeria, it's not about emotion, it's not about guesswork. I'm going to show you how to check for sectors that have been hot and sectors that will continue to be hot. And guess what? You don't just look at the sectors after our research. You also need to find reasons. See, there's a difference between knowing what sector is hot and why they are hot. It is in that why, that reason, that your confidence is improved. That's what makes it a high conviction stock. Because when you just buy it without conviction, without strong conviction, a time will come you will sell. You will just wake up one day, open your system and see that the stock is down. Then out of fear, you sell. So it has to be a high conviction stock so that when you open your system, when you launch your platform, or when you open your investment account and you look at it and the stock is still down, you are not bothered. You're not part of because you know it's still in a hot sector. It's just a matter of time it will pick up. Look at the price of food in the last 5 years, in the last 10 years. A lot of them have moved by over 200, 300, or 400%. And tomorrow, most likely price will go up because the factors responsible for that uptick is still there. So let's look at how to fish for the hottest sector in Nigeria, especially sectors that will continue to be hot for an extent. See, that extended is very important. It's not just hot sector now, for as if we are trading. We're looking at sector that will be hot for an extended period. That means they are hot today. They have been hot yesterday, 5 years ago. They are hot today. They'll continue to be hot in the next 5 years, in the next 10 years, in the next 15 years. So what you are riding, you're riding that trend. That's what you're looking for. So if you had held a stock for in the last 5 years and the stock made money, go and check the reason that stock made money. It is not because you were holding for 5 years or 10 years. It's because that stock, most likely, check very well, is because that stock is in a sector that has been hot for an extended period. Very important. This secret would shape your mindset, will help you when it comes to long-term investing. Now, let's move on to how to fish for sectors that are hot in Nigeria. So let me show you what I do anytime I want to fish for sectors that are hot in Nigeria. So first thing I do is to call up my Nigerian NSE All Share Index. Here, this is ASI, NNGS All Share Index right now. You can see where it's sitting right now. So I'm going to compare it with different industries, the oil and gas, the banking, the consumer goods, the insurance, as well as the industrial. So let's see industrial, NGSIND, yes, industrial index. So we have, let me see, insurance. Okay, so these are the major indices in the market. We have the NGS. Sorry, let me add this NGS insurance. Let me change this color to yellow. Let me change this color to oil and gas to white. I want to differentiate them properly. Okay, all right. So let me change to banking. Okay, let's work with this. Now, these are the sectors in Nigerian stock market right here, and they also represent a major part of the economy. So we have the oil and gas, the banking, the consumer goods, the industrial, and the insurance sector. So these are the subsector. All the companies listed in Nigerian stock market, they fall under one of these sector. So this covers everything. Then we have the NGS itself, the ASI. Now, what are we looking for? If a sector is going to be hot for an extended period of time, it's most likely that that sector has been hot in the last 5 years. That's important. If a sector is going to be hot for an extended period of time, then it means that that sector must have been hot in the last 5 years. So we want to look for stock in sector that have been hot in the last 5 years and are hot today and will continue to be hot in the next 5 years. So this is like a clue. It's not a uh, perfect model. But it will guide you most times I've found it very useful when it comes to sectors that would be hot for an extended period of time. Because if a sector is going to be hot for an extended period of time, then it must have been hot in the last how many years? 5 years, 5 years, 10 years. So on my chart, I will then click on 5 years. So these are the sectors. Now, first thing is let's locate the NGS ASI, which is the All Share Index right here. You can see this is the ASI. The All Share Index is sitting at 294. So first thing we want to check is the sector that have outperformed the NGS first. These ones are the top sectors. ASI sitting at 290%. That means in the last 5 years, Nigerian Ocean Index has risen by almost 290%. That's what it means. So we see that insurance is sitting at 435.2. Then the oil and gas is doing almost 944. You can see them right here. You can see oil and gas is doing 944. The insurance is doing 405. So the two sectors that have performed the market in the last 5 years is the oil and gas and the insurance sector. So those are the areas you need to watch out for. Then after then you have the industrial stocks. Can you see here? The industrial stocks, you have the banking stocks, and then we have the NGS consumer goods stock. Now, all these sectors have been hot. You can see they have been up, but the NGS oil and gas is top, followed by the insurance sector. These ones have outperformed. Now let's do all since inception. Now you can see again, the ASI is up by 183%, followed by the insurance sector, which is up by 395, and then the oil and gas has done 1,377%. You can see here, right here, you see 1,377%, followed by the NGS insurance sector. So my first two sector is oil and gas and insurance sector. Oil and gas and insurance sector. Oil and gas and insurance. Then the third one we have here is the banking sector. You can see here 179%. 179%. That's for all the banking sector. You see right here, 179%. Now, followed by the consumer goods sector, 68%. So for me, my top is the oil and gas, the NGS insurance. That's for all since inception. Since inception. Then followed by the banking sector. Well, remember, the ASI has outperformed the banking sector by 100, I think by an average of 4, 4%. The ASI is doing 183. The banking sector is was 179. So the oil and gas and the insurance sector are the key sector to watch for both capital appreciation and dividend. Now, it doesn't mean that other sectors are not okay. So please be very careful. Don't say I said the oil and gas and insurance sector are the best of all. But then from the data I have here, the oil and gas, and if you drill down to 5 years, you see the oil and gas and the insurance sector too. The oil and gas and insurance sector in the last 5 years, for all here means from when TradingView started tracking the Nigerian stock market. So we still have both the oil and gas and the insurance sector. That's why you have your two. Then followed by the third one is the industrial sector from 5 year term. And then if you go by all, you have the banking sector, then the industrial sector is the least. So you might not add other sectors. Maybe you want to add the consumer goods sector right here at 68%. But then I'm looking at the oil and gas and insurance sector. These are the areas to watch out for long-term investing. Now, is this correct? That's the question I want to ask. There's a difference between knowing what and knowing why. Is this correct? Data said the oil and gas and insurance sector are the top performing. They have outperformed every other market, both in last 5 years and all for since inception. Is that correct? Now, let's look at the catalyst behind this growth. If you look at oil and gas today, almost everything that happens in Nigeria revolves around oil and gas. Oil is a major revenue earner for us in Nigeria. It's a major revenue earner for us in Nigeria. So if you hold a stock for a long time in the oil and gas sector, Seplat has proven that you are going to be profitable, especially if it's a stock that has good fundamentals. And look at other stock in oil and gas again. You have Total. You have Total. Total has done well. Now, like I said, there will be fluctuations, but over time, these stocks have done extremely well. Total has done well. This is Total right here. Total has delivered 331% in the last, let me see the 5 year performance of Total. Total has done 507% in the last 5 years. Can you see here? And if you look at other stock in the oil and gas sector, like MRS oil, corn oil, a lot of them have done well because of events that is playing out in oil and gas. Policies, opportunities, merger, you see sales of offshore, acquisition by indigenous company, Owando is emerging, a lot of them. So your job now is to look for companies in the oil and gas that still has huge upside potential. I'm going to tell you some of the things to watch out for in that particular sector. So here you now have a guide. Do you understand? You have clarity as per where you should buy your long-term investment from. So from this chart, oil and gas is number one. If you're looking for a stocks to buy for long term, focus on oil and gas. Number two, insurance. Now, insurance may not be loved. Like I said, regardless of how you feel in the market, insurance may not be loved, but some insurance stocks have done well in the last 5 years. I can tell you that. Some insurance stocks have done well. Look at a stock like NEM Insurance. NEM Insurance here. This is it here. NEM Insurance. NEM Insurance. In the last 5 years, NEM has delivered 407%, almost trailing the performance of the insurance. So that means one of the major driver of insurance index is NEM Insurance. If you check NEM financials, very good. There will be fluctuations, but look at how the company has performed. And insurance companies are benefiting from a lot of events. First one is interest rates. CBN has been increasing interest rates, and from what I see, they might probably continue to increase because they want to tame inflation. And that means more opportunities for insurance stocks because insurance stocks invest their premium in fixed income securities, money market instruments. So if interest rate is going to If interest rate goes up, then it means money market fund, fixed income market will be a lot more attractive. So any insurance company that's able to raise money, that's able to make more money from premium and invest in this market will make more. That's why on insurance financial statement, you see investment income, interest income. Insurance also benefit from FX. Some insurance company are building their FX reserve. One of the major driver of AXA Mansard is FX. Look at how much they are making. Look at custodian. So these are stocks that are benefiting from trend. Like I said, it's a different thing knowing what to buy for long term. And then it's also a different perspective entirely knowing why you should buy them. It is in that why that you have your conviction. Mansard has delivered in the last 5 years. Mansard has done 290%. Trend very key. Stocks that are in a hot sector that will continue to be hot for an extended period of time. So knowing why those stocks are hot will make them a high conviction stock for you. So the question is, will CBN continue to increase interest rates in the next 5 years? If the answer is yes, if CBN continues to fight inflation with interest rates, if CBN continues to, so if all those policies that have helped this sector to grow, if interest rates and exchange rates are still going to be hotter in the next 3 to 5 years, then it means this company will continue to benefit. So you can see from here, my top two sector for long term is oil and gas and insurance. The truth is it doesn't respect your emotion. You can argue with it, but this is data telling me this is how I trade. Even if I do not expect insurance company to show up on my screen, it still doesn't mean insurance is not good for investing. Now, note, it doesn't mean this is the best sector. There are other good sectors. We have the consumer goods, food inflation, they are all up. But I'm looking at a sector that will outperform the markets. I'm looking at an outperformer. Talk that when I hold in the next 5 years, I know very well that it will outperform the market very, very well. So these are the kind of things you should watch out for in the market. So I've shared my top two stocks. Others like banking are okay. They have all done well in the last 5 years. But then I'm looking at CBN regulations. CBN can come up with one circular tomorrow, banking stocks will top. But I'm looking at stocks that have that history of stability in terms of capital appreciation. The capital appreciation is very key for me. Banking sectors are good for dividend. But if you're looking for significant capital appreciation that will last for a long time, except it's being driven by CBN policy. One of the major reasons a lot of banking stocks are appreciating appreciating currently or in the last 1 year is because of capital base. And capitalization will not come every time. The conversation will not come every time. You don't know the next one. Maybe it could be in the next 10 years, 15 years, 20 years. So this is just a temporary event that may not justify banking stocks and dividend growth stock. But if you are looking, when I say dividend growth stock, I'm looking at something you can buy now and hold for a long time, be rest assured. Now, it doesn't mean banking stocks are not good for dividend and capital appreciation. Very good. You can find them, but something that will give you steady return. This is data. Oil and gas still remains the best, followed by insurance. You will get your dividend. Mansard has been paying dividend. Custodian has been paying dividend. NEM has been paying dividend, and their share price are still surging higher. That's the kind of stock you want to buy. Now, you still find a lot of opportunities in the insurance sector. This year, a lot of insurance sector have rallied higher. You find a lot of opportunities. So if you can find emerging stocks in the insurance sector that has the history of dividend, consistent dividend payments and capital appreciation, I bet you will make money in the market. So these are the things you need to watch out for whenever you want to invest for a long time. Now, in the consumer goods sector, there are also good stocks there. There is the BUA Foods days. But then when you buy this kind of stocks, you're going to make money too. But then I'm looking at outperformer. So this video is actually designed for investment that would outperform the market and outperform other stocks. So that's what you need to watch out for. So let's continue our analysis right here. Then once you have found the stocks to buy, now, like I said again, companies in the hotel sector for an extended period of time tend to report consistent growth in revenue over 5 to 10 year period or more. Then top sector events are major catalysts. I just talked about them. We have your interest rates, you have your exchange rates, you have a lot of policies that are driving And then in the oil and gas sector, you see a lot of things are playing out today. So oil and gas, every look at the media headline, newspaper, there will always be news on oil and gas every month, month or month, month or month, month or month. There will always be news on oil and gas. So now, when you find a stock in that sector, look at the kind of stock you should focus on. Focus on dividend growth stocks in the market. Focus on dividend growth stocks in the markets. Once you spot the hottest sectors that are outperforming, like I said, the market index, dig up the dividend growth stock opportunities in sectors and build a diversified portfolio. So imagine owning dividend growth stock in oil and gas, dividend growth stock in insurance, and then maybe dividend growth stock in industrial, maybe just to add or a bit of other sectors too. Dividend growth stock. So owning a collection of dividend growth stock in different industries that have recorded consistent dividend payments, as well as going to give you significant capital appreciation, is actually the secret behind long-term investment, profitable long-term investment. There are companies that pay regular dividend and increasing payouts every 2 to 3 years. These are dividend growth stocks you should watch out for in the market. Very important. So with first one, you found a sector to invest in. Second one, you look for dividend growth stock in that sector, and then you buy those kind of stocks. Now, investing in a collection of dividend growth stocks can help you beat inflation in the long run. They are not only generating steady cash flow, but sustain your capital growth as well as the real value of your money. So when you invest in a collection of dividend growth stock, it can help you beat inflation. So if you're looking at a long-term investment that will beat inflation, then focus on dividend growth stock, because by collecting your dividend and reinvesting it, you are enjoying capital growth, capital appreciation. And again, that growth nature of your dividend would help you beat inflation, because in the next 5 years, next 6 years, you're sure that since there's an element of growth, that element of growth is driven by the sector that you have invested in, then you should see your portfolio outperform inflation. So let's move to the next slide. Now, focus on profit margin. This is also very important. Very important. Companies that have high profit margin enjoys competitive advantage. Now, you do not want to hold a stock for a long time without without looking at the competitive advantage that that company enjoy. You don't want to buy a stock that tomorrow competition will just come and sweep the company away. So they have to be competitive advantage in that sector. Some companies enjoy competitive advantage because of regulatory policy. Not everybody can just start an oil and gas company. Not anybody can just go into upstream. Not everybody can just. So for me, that sector is very, very limited. The regulatory environment is very tight. You see that before a company can conclude a deal, it can take 5 years, 10 years, 15 years because of regulatory policy. It's actually a competitive advantage for the few players in that sector. So a good way to check for this to look at their profit margin. Look at net margin. For me, I like net margin above 10, 15% in the last 5 years. So any company that has enjoyed competitive advantage most likely report higher profit margin. Why? Because by increasing their revenue, increasing their sales figure, they generate more profits. Why? Again, people don't just leave. There's no perfect alternative. You can't do without them. So when they increase their product price, it automatically gives them more revenue because you don't have any option. Demand is always constant. Inelastic product. You can't do without oil and gas. If tomorrow the price of oil goes up tomorrow, or price of fuel, do you stop using them? No, at least for now. So these are the kind of companies you want to buy. They enjoy competitive advantage, and hence their profit margin is above 15 to 20%. The higher the profit margin, the better. So you need to look at this over time before you can check whether it's a company you want to invest in. Competitive advantage is very, very key. There must be something the company is doing that is making it different from others. You have to find out. It's very critical because you're holding it for long term. It's that competitive advantage that will also help drive the share price in the future. Then focus on low debt and high return on equity. Don't just buy into a company that is too exposed to debt. So there's something I want to show you right here. All right. So look at these companies here. Here. So I just imputed few metrics that will just help me find few companies that are good for long-term investments. Now, if you check what we shared earlier, the first top performing sector is oil and gas. So, and from here, one of the stocks that showed up on my screen that still has huge upside potential is Aradel. You can see here, Aradel. So Aradel has a market cap of 1.34 billion. Now, yes, dividend may not be impressive, but if you look at the fact that the company is in oil and gas, and then look at the metric right here, you see the gross margin 48.8%, net profit margin 64. This is net profit margin average 64%. 64. Look at revenue growth in the last 5 years, 30.78, EPS 45.33, income 51.41. So this is a company you might want to consider for long-term investing. So this is a company you might want to consider for long-term investing based on all that I shared so far with you. So this is a company you want to consider for long-term investing right here. Remember, oil and gas. You're looking for an outperformer, oil and gas. Very important. So look at this company. So if you are also looking at dividends here, you see that dividend is around 1.3. But what matters for me is consistency in payments of dividends, as well as that long-term capital appreciation. It's very key, is very, very important. So this is key. So one stock that is emerging, they recently got listed and that has a lot of upside potential for long-term investment is RDM. And you can see one of my major reasons they are in the oil and gas. And from our check, the oil and gas sector is actually a major performer in the market. So can you see here? So when you do your research and you're able to find collection of different stocks, what will guide the type of stock you should focus on is the sector, because you're looking for sector that has outperformed the market for an extended period of time. So if I have a list of stocks here, oil and gas is key for me. Now, it doesn't mean other stocks would already higher. After all, I have picked BUA, sorry. I've done all my research and all that, and I also found BUA. There are many ways to pick stocks for long-term investing. Do you understand? So and also there's food sector too. Even though food sector is not a major outperformer, but over time, you will see that the sector has done well in the last 5 years. NGS consumer goods sector is up by 196%. You can see here. So almost all the sectors have done extremely well. So that still does not negate other sectors that I've mentioned um, so far. Now, look at other sector here. You have BUA Food. You have your NASCON here. NASCON is also a very good. In short, NASCON has been beaten down and is in a food sector. Food sector is hot. So the dip you're seeing here may not be good for trading, but for someone who is considering long-term investments, this might be the best time to pick up this company at a lower price because they are in a hot sector. Very soon, management will come up with one or two policies, and before you know it, the company fortune will turn around. Look at Okomu, look at Presco. They are also in the food sector. Look at Okomu, look at revenue of Okomu. Can you see right here? Look at margin, 26.1%. Average margin in the last 5 years is 26.35%. So when a company has above average margin, above industry average margin, then it means the company is actually enjoying some competitive advantage. That's what it means. So above average margin of 11%, 15% is very, very good. So if I go for margin above 15%, you have the likes of Aradel, you have the likes of BUA Food, you have the likes of Okomu Oil, you have the likes of Presco. You can see it. These are companies you can hold for long term because of their competitive advantage. Presco, Okomu Oil, BUA Food, and Aradel. Can you see a combination of these four stocks? Now, there is no insurance stocks right here. Maybe because their prices have rallied higher or their average. I know sometimes this data you see here, they don't get to pick they don't get to pick all the companies. I've seen it multiple times. For instance, if you look at NEM on TradingView that I used to analyze data, NEM is not even showing any figure. On board revenue, it's just showing hyphen, hyphen, hyphen. So don't rely on this website for analysis. Deep down, do the dirty work. Go to the Nigerian Stock Exchange website, download financial statement, and do your analysis yourself. Most of the data entry, there are mistakes. I've seen that multiple times. I'm telling you from experience. If I go to TradingView today to analyze data of NEM, you'll be surprised that NEM figure is showing hyphen, hyphen, hyphen. That means when you run your checklist of criteria, or input all your criteria, whatever, you will not see NEM. So there are some stocks that will be hidden because the data is not posted on the website. So go to Nigerian Stock Exchange website, you will find all the information you need on that particular stock. So we mentioned focus on profit margin, low debt to equity is also important. Low debt to equity is also important. So let's look at each of these companies again. Now you can see RDM. Can you see here? You can see this data. You can see this is exactly what I'm saying. So not this most of these websites cannot give you the data. You can see hyphen, 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 hyphen. You can't tell me price any ratio is hyphen. It's not possible. Can you see? So those are the things you need to watch out for. Look at BUA food, low debt to equity. Can you see 0.4? Look at payout, 47%, interest cover 2.4. Look at price any ratio, 34. There's something we call PEG ratio, price earning to growth rates. Now, when you're holding a stock for a long time, you also need to look at how cheap the company is today relative to the value or the projected growth in the future. So price earning ratio tells you how much you're paying for that stock based on its current earning. So when you compare the price earning ratio of that stock with the average growth of that stock, you can see BUA Food earnings is 98% in the last 5 years. Earnings per share growth 98.38% in the last 5 years. So PG ratio says that if a company is growing faster than what you are currently paying for, then it's a cheap stock. BUA Food in the last 5 years has grown by 98%. That's the earnings. And you're paying 34.2%. So 34.2% divided by 98, that will give you 0 point something. So PG ratio below 1 means that the stock is cheap. That's what it means. The stock is cheap. So like I said, our performers are in oil and gas and insurance, but it doesn't mean other sectors will not be considered. All other sectors have done extremely well. So assuming there's an insurance stock right here, I will go for oil and gas and insurance. So what this exercise will guide you, that would exercise we just carried out, what it will guide you is that it will help you know the sector to focus on when you have multiple options. That's what it means. So this is not telling you the best sector. It will tell you the sector to focus on when you have multiple options. So if you have multiple stocks that are showing up right here, and you're asking, oh, which should I go for? Maybe because you have limited budget, limited amount you want to invest in. This will now tell you, okay, if you find oil and gas, then you should go for oil and gas stock. Aradel is there. If you find an insurance stock, then go for insurance stock, right? Which of them after insurance? If you find industrial stocks, go for industrial stocks. If you find banking stocks, followed by consumer goods stocks. If you use all, if you find oil and gas, insurance, banking, consumer goods stock, and so for me, yeah, I would rather go with all. I like to go with all and 5 years. The all and 5 years would help you solidify your peak. That means anyone that is hot in both all and 5 years, that's a very good one. But if you have multiple options, go with all because all is more extended than 5 years. All is like since inception. So any stock that have been hot since inception, then it means that will continue. That's why it's not just about what is hot now, but why the catalyst behind it. So consumer goods stocks over banking stocks. Consumer goods stocks because of inflation. Because of inflation. And we have consumer goods stocks here like BUA food. So there's more on our peak. And then if you look at a stock like NASCOM here, you will see NASCOM PEG ratio is 7.17. That's what we are paying for because the share price has dumped. NASCOM has dumped extremely well. So let me take out all these indices so that our chart will be clearer. Let's look at NASCOM stock. Look at NASCOM. NASCOM has, look at massive sell-off, dump from a high of 66 because of the merger, but the failed. Then you see right here, it dumps to 31 naira. So I'm hoping that this company would find bottom around this region very soon. But then I'm waiting for the signals. Financial settlement is yet to improve. But then, if you look at it from a long-term investment perspective, they are in the food sectors. Look at the average revenue growth, 25.69%, EPS 25.4, net income 25.44, total capital to debt less than one. That means they are largely funded by equity, not debt. Look at the payout, 45%. Average payout below 50% is okay for me. I don't like a company to pay out a significant portion of its profits to shareholders. So below 50 is fine because you need more money to invest. You need more money to finance growth. If a company is paying out all its a significant portion of net income, what does it have to finance growth or expansion tomorrow? So 45% is fair. Interest cover, fine. That means it can actually pay up its interest expenses from earnings before interest and tax. Then PEG ratio, 7. So 7.1 divided by 5-year growth in earnings, 25. That means this company is still cheap for long-term investments. NASCON is still cheap for long-term investment. For anybody that's looking to pick for long-term investment. Long-term investment doesn't necessarily need to be hot today. Investing for long term is a boring journey. It's not lively like short. Oh, I want to get good short term return. It's boring. Long term investment is boring. But if you do the right thing, you would definitely get the reward for that decision. So let's continue. Then return on equity is also critical. Return on equity is also important on each of these stocks. So let's look at return on equity. So you can see another return on equity 16.1%, which is fine. I like return on equity above 15%. BUA Food 38%. You can see here NASCON return on equity 34.61. Can you see? So despite the dip on NASCON, I still think that the long-term potential is still there because one, the companies sell inelastic products. So all management needs to do is to restructure. See, every long-term investment will always go through its bad period, bad days. It doesn't have to be good, good, good every year. There will always be bad year. There will always be bad period. So I guess this is what's happening for on NASCON. And if you are able to pick up the stock confidently for long-term investing, you will reap the return. Because if you look at the metrics in the long term, this company still has good potentials. And then when you consider the sector, food. So let's continue. Now, focus on company with strong cash balance. Cash and profit are not the same. I always say this. Businesses that pay bills with cash, businesses pay bills with cash, not profit. So it's important to hold stock of companies that have positive cash flow, positive free cash flow. Yes. If you go to the cash flow statement of every company, you will see it right there. Then focus on high dividend yields. Yes. What makes dividend growth hot, aside from strong fundamentals, is the juicy dividend yield. It makes the return attractive to institutional investors before the share price appreciates. That's why the best time to buy a stock for long term is not when it is up, it is when it's down. It is when the stock is down. For instance, now with NASCON that is down, dividend yield will be higher because it's a risk. And what's about dividend yield is that once the risk on the company is high, yield will be attractive. So anybody that can take on that risk at that moment and eventually turn out to be positive in the future, then the person is going to reap higher return. You find the best or highest dividend yield in market dip, not market rally. Very important. That's why I always tell people in my community, when you want to invest for long term, the best time to find long term investments is in a bear market, not in a bull market. In a bear market, because in a bear market, dividend yield will be attractive. You see some stocks offering dividend yield of 15%, 16%, 17%, 18%. The last major crash we had that moved Zenny Bank, that dragged Zenny Bank down to 11 to 12 naira. Dividend yield was around between, I think, around 15, 16, 17% or thereabouts, or even more at the peak of COVID. So you find the best dividend yield in a bear market, not in a bull market. Because as price goes up, what happens? Yield will dump. So focus on the high dividend yield. Now, cheap stocks is very key. I just shared that. In the Nigerian market, on stocks, cheap stocks are not companies or stocks that sell below 5 naira or 10 naira. When you have two stocks to buy from and to select from, and one is selling for 1,000 naira, the other one is selling for 5 naira, that 5 naira one is not cheap. 5 naira stock can be cheap, can be expensive compared to 1,000 naira. What makes a company cheap? what makes a company cheap is growth. So there are companies that are growing sales profit faster than price earnings today. So cheap stocks are not stocks that sells below 5 naira or affordable in terms of price. No, they are companies that are growing sales. So any company that is growing sales, net income faster than price earning, they are the company we call cheap stock. So we use the PEG ratio. PEG ratio is price earnings to growth rate. That means you divide the price earning multiple or price earning ratio to the growth rate. This is what I mean by that. Remember, a company that is growing sales, net profit, and earnings faster. Look at NASCOM today. In the last 5 years, this company is growing sales by 25%, earnings by 25.4, net income by 25.44. Now, what is the price earnings? Price earning is just 7. 7 divided by this growth rate will give you less than 0 point something. So price earning ratio below 1 means that the stock is cheap. That's how you know a cheap growth stock. So if you're looking for a stock for long-term investments, look for companies that are cheap today. And the best time to find them, like I told you, are in a bear market. So NASCON has been growing through extreme market sell-off. And right now, the stock PE multiple is around 7.7. Yes, financials may not be good. But you know what? For long-term investing, quarterly financials is nothing. You don't pay attention to quarterly financials. For long-term investing, what you pay attention to is annual results, annual reports. So if you look at the annual results over the years, like we've seen here, this company has been growing earnings by an average of 25%. And price earning multiple is just 7. So price earning multiple divided by growth rate of 25, that's like 0 point something. Then let's see if we can find another stock again. Look at BUA Food, 34.2. And then look at the average growth rate in the last 5 years, 59, 98, 98, below 0. Now, let's look at another company like, look at Lafarge, 28%, 45%, sorry, 13%, 28%, 45%. And there was the price earning multiple, 15.4. So 28 divided by, sorry, 15.46 divided by 28, 0 point something. But Lafarge for me is yet to meet my long-term investment objective. So for now, Lafarge is good for short term. In short, we have traded it for short term. It's not a buy. It's not a buy. So just know that. There's a way to know whether a stock is good for long term or short term. Now look at Aradel. The price earning multiple is not available. But then if you look at the growth rates, 13, 45, 51. So if price earning multiple is below the earnings per share growth rate, then this is good. This is a cheap long-term stock to consider. But then for the fact that it's in oil and gas, for me, is already a must pick for long-term investment. So look at Okomu Oil. Look at PE ratio 13.72. You see sales 19, earnings 19.1. You can see here almost below 0.2. You can see 13.72 divided by 19.42 below 0. So Okomu Oil. Look at Presco 7.7 divided by earnings of 50.3 below 0. Did you see that? So from here, you have Aradel is fine, BUA is fine, NASCON is fine, Okomo and Presco. You can do your research to check for more stocks. Mine is just to guide you and help you pick stocks for long term. Remember, we are picking our stocks from sectors that have been hot for an extended period of time. So in January, when we'll be having our first New Year webinar, I would be posting stocks you should be looking at for long term. Detailed research. All the stocks I mentioned, some of them passed, some of them did not pass. Do you understand? So I'll be posting stocks you should consider for long-term investment properly in our portfolio. But one of them is going to be Aradel because Aradel is actually in oil and gas. And you can see from data, Aradel is one of the hottest. Aradel is in a sector that has been hot for an extended period of time. So I'm inviting you to join our Globfolio community as a first timer. This is the first time you're watching my video. Kindly click the subscription button or turn on the notification bell. If you want to join my community, you can go to globfolio.com/subscribe, pick a plan that works for you, and then you can pay online. We host monthly webinar and share market insights, Charlie stock picks before the media. So thank you so much and enjoy the rest of your day.